and welcome to Economics and You. I am your host, Mr. Samuelson. Today we are looking at national income accounting. What is national income accounting? Well, our nation's economy is measured through this process. We have to account for our national income. That is, we've got to add together a whole bunch of things and find out what our economy is actually worth. Now, there are 5 ways that we do this sort of national income accounting. We've got to look at our gross domestic product. It's not actually that gross. It's actually pretty interesting. We have to look at our net domestic product, our national income, our personal income, and our disposable personal income. But really, there's one that we've got to focus on the most, and that is our GDP, our gross domestic product. I'm going to call it GDP most of the time when we talk about it, so just get used to that. This is our broadest measurement of the economy. It's going to look at the most information to really add everything up together for us. It is the total dollar value of all final goods and services. We'll get into what final means in a minute, but remember, it is goods and services. And it is the value of all these for a single year. Now, the GDP is always expressed in a dollar value. It's much easier to just attach a dollar value to paper clips and cars and houses than it is to add up together and express it all as paper clips, cars, and houses. So we like to attach a dollar value to this. Just to get a perspective on it, our US GDP in 2015 was $21.9 trillion. So that is a lot of goods and services produced in that single year. Another way that we like to look at it is growth in GDP. And on this chart right here, we can see our growth in GDP. And if you remember from previous conversations and more future in-depth things, when we have negative GDP growth, that is, our economy is actually getting smaller, we have these recessions. And you can see the Great Recession right here, smaller recessions showing up in other places. All right, final measures of GDP. So what does that word final mean when we talk about products? Well, it means that we're looking at just the new products and the things that are actually sold to the public. So for example, if we've got a brand new car, this one right here, shiny and new, the total value of that new car is what is calculated, not the value of all of the individual pieces that went into the car, just the one final product that is sold. That is, we count the value of the car as a whole, but not the value of the individual tire. If, however, you drive this brand new car off of the lot and a mile down the road you hit a nail and you blow a tire, well, now you've got to buy a replacement tire. The replacement tire would be measured in GDP because it is a final product. It is a replacement for something else, but not included in the whole product as it was new. Okay, so you go out and you buy a car, or you go out and you buy a tire. But we're not thinking when we go out and buy a car, we're buying the car, we're buying the tire, we're buying the headlights, we're buying the seats, we're buying the cup holders. No. We just buy the car, or we just buy the tire. Now, that new car would be counted. However, a used car is not a new product. It is something that is existing in the economy already, and when you purchase a used car, you are just transferring ownership of a product that already existed in the economy. Does not count for GDP. It is not a new product. It must be final and new for GDP. Or, of course, services, as we mentioned in our previous slide. Don't forget that's services. So your labor is a service. If you work for a company, you are selling your labor, and that is a service to that company, and that counts. All right. Computing GDP. So how do we add all this stuff together? To derive the GDP, economists look at 4 numbers. Consumer purchases. So you go down to the store and you buy a donut. That counts. That goes into GDP. You go down to the car dealership and you buy yourself a Ferrari. That counts. That goes into GDP. That is a consumer purchase. Remember, consumer purchases of new products, not used products. So going to Craigslist does not count. Number 2, investments by businesses. Now, investments, it's easy to think of things like stocks and bonds and et cetera, et cetera. That's not what we're talking about here, though. An investment by a business is a capital investment. That is, when a business goes out and they buy a new factory or they buy new machinery, they invest in their own business by investing in those types of capital products. So those are investments by businesses, and those count. Government spending counts. So when the government goes out and builds a new road, the spending that goes toward buying the supplies and paying the labor costs and all of that, that is a government spending that counts toward GDP. And then finally, net exports. That is the total value of all the goods sold to other countries minus the purchases from those other countries. So in our equation, that right here is x minus m. Our exports minus our imports will get us our net exports. Now, in the United States, for quite some time now, our net exports have actually subtracted from GDP. Our net exports being about -2 to -3% per year. That is, we buy more things from other countries than they buy from us. So we have to subtract that from our domestic product. We're losing money there. All right, net domestic product. This is our second thing that we're going to look at, and the other 4 items in our 5-item list are less important. They're only going to get a slide apiece. We have our net domestic product. So what is this? We had gross, now we've got net. Well, the net domestic product is a measurement which subtracts the loss of value caused by depreciation. That is, sometimes we have items that just lose value over time. Okay, think about factory equipment. It's losing value. And sometimes we have to purchase replacement parts for it. Okay, or think our car example, the replacement tire. Okay, that is a maintenance and repair cost, not a new item cost. And in net domestic production, we don't count those things. Those are subtracted from the total value of the economy because we're not really adding anything to it. We're simply replacing things. We're simply maintaining the economy. And the net domestic product wants to take that out of the equation. So our NDP is our gross domestic product minus depreciation. And this chart shows you, kind of gives you that visual on what percentage of our GDP is this replacement cost, maintenance cost, to get to our NDP. All right, national income. National income. What is national income? Well, it's the total income earned by everyone in the economy. Okay, so we're just looking at earnings here of every individual and company in the economy. This includes 5 different sources. We've got our wages and salaries. That is, what do workers take home at the end of every pay period. Number 2, self-employed income. Okay, so sometimes you're not an employee working for a company. You're not a teacher working for Pontiac Schools. You are a self-employed individual. That is, you sell your own product, you sell your own service. Well, that counts too. We've got rental income. You might be a landlord and you rent out some apartments. That counts. You could be a business. You could be a huge multinational corporation. The money that Facebook makes off of ad revenue, the money that Nike makes from selling shoes, that all counts. And then finally, interest on savings and investments. You put some money into the bank, you get an interest payment from the bank, that counts. That is all included in your national income, and that's another way to measure our national economy. Next, we have personal income. Personal income is like national income, but it only includes some aspects of it. It's just going to look at what an individual makes. So wages and salaries, rental income, self-employment, those all count, but the big corporate profits of Nike, those don't count within personal income. Now, government assistance benefits are added to this number. They consider if you're getting food stamps, the value of the food stamps is, in a way, income. So those get added to this particular measurement. So this is supposed to show the value that every individual in the economy has and has the ability to potentially spend. Now, a lot of that goes toward taxes. So we have our disposable personal income. This is where you take the taxes out of that equation. You're going to forget that the taxes exist. What do people have after their taxes? Another thing they do here, though, is they take away government benefits. They're not included in this measure. So you look at, again, the food stamp situation. That's not going to be included here because people don't have a choice in how they spend their food stamps. They have to spend it on food. So this is just how individuals can spend the money that they have control over. Remember here, however, the difference between disposable and discretionary income. Disposable income includes things like you still have to pay your food, you have to pay for shelter, you have to pay for clothing, you have to pay for these basic needs of survival are still included in your disposable. This is not discretionary, which is after basic survival is taken care of. So disposable personal income, I can choose to eat or not eat. Hopefully I choose to eat. I can choose where to live. These are all choices that I make. I have control over it, so this is part of my disposable income. I don't have control over whether I pay taxes. Those have to be paid. All right, these were the 5 ways that we measure the economy in the United States. Thank you for joining me today. I hope you learned something, and farewell.